Hey, my friend, welcome back to another video. Today we're going to be going through my covered call positions on ELF, Celsius, and we're going to be talking about why it is important to stay calm when your covered calls go in the money, especially deep in the money. Okay, let's get into it. So here we have my ELF $90 call. Now, in my last video, I talked about ELF. I didn't yet initiate this position. So what I did, it was a $90 call that expired on August 21st. I ended up rolling that. Most people, when they roll a position, they go out in time. They try to collect a juicy credit, but they also try to extend that strike price. Now, what I did was I actually extended the time, but I didn't extend the strike price. So I did a 90 call, extended it about 1 month to September 18th. I collected about, I think it was about $300 at the time of doing this. Yeah, 330 bucks. And yeah, basically just extended the time. Now for me, I was willing to let it go at 90 bucks, get my $9,000 collateral back for selling the shares. Now, when you think of it that way, it's like no matter what, in your head, you're a winner, right? You're ready to sell the shares at 90. Doesn't matter if it's 105 or 110 or 150, you're ready to sell it at 90. I collected 330 bucks, which is like 3.5% ish, and basically just extended the time. Now, a lot of people get so hung up on the stock, get married to the stock that they have to roll it no matter what. But then I've seen countless times where you roll a position higher and then it actually ends up dropping because the stock market is totally random sometimes, right? So the stock could literally go back down below 90. Some people think it'll just never go that back there again. So I collected a juicy premium. Now, and I have the protection. That's the beautiful part of this. It's like, yeah, the stock could go up, it can go way up, but it could also go back down, right? So that can give me a better opportunity to, manage the position as well. Because I have that protection. Now, if it goes from anywhere from 105 to 90, that's the beauty of cover call, is you're also taking on a lot less risk because now there's a buffer, right? You can go down to like 95 bucks, right, from 105, and I have that cushion because I was ready to sell it at 90 anyways, and now it's a lot closer to my strike. Of course, it can go up. There's a spectrum of possibilities, but the important thing is that I collected a juicy premium, and I've just been, really just collecting premium on this really good premium. So, yeah, $90 call. Just wanted to update there that it expires September 18th. Let's just take a look real quick. If I was even to roll it now, let's just say I wanted to roll it for whatever reason. The current price is 105. Now, if I were to literally just keep the strike, right? Remember, when you roll, you don't have to actually go past the current stock price in order to make a difference, right? I don't need to go past 105, right? Because if I did that, I would be paying $1,645 to close it today, and I would have to roll it, let's say, to the current strike price and get paid 645 bucks. I would be down $1,000, right? Of course, I would increase the strike about 1,500, but pay 1,000 to get that 1,500 strike. You're still in a risky position because if the stock goes down, you paid $1,000 out of pocket, and now you're really only winning if the stock keeps going up, and then you lock in that upside, and you're only getting about 500 bucks or 600 bucks, right? So let's say you wanted to roll it to 95, right? You're paying 1645 today, and you get $500 of upside, raising it from 90 strike to 95. You'll get paid 1,238 bucks, right? You're still paying a difference of 300 bucks ish, right? And oh, that's only 1 week. Let's say let's go to October 16th. Sorry about that. So let's say here, so with that previous example going to 105, yeah, you're still in the money, in the hole, like, yeah, like 800 bucks. Now, let's say here for the 95. 95 is closer to the money, closer. 1645 you pay. 95 you would get paid 1490. It's like 155 bucks, right? So, is that right? Dang, my math is pretty good. I think that's right. Okay. Uh now let's say we keep it at the same exact strike. Okay. Same exact. Remember, you're ready to sell it at 90. And by you, I mean me. Okay. 90 bucks. If you close it today and open a new position for October 16th, today, I'm not going to do that. There's still so much time left on the contract. But hypothetically, if I did that, I would get, I would have to pay 16.45 today, open another contract for October 16th, and get paid get paid 1828 bucks. So the difference between 1828 and 1645. Let me just do the math really quick. So 1828 minus 1645. That's 183 bucks. That's about 2% more of premium. I would still be basically obligated to sell those shares at 90 bucks if the contract either expires or is exercised, right? But the point is, I'm still collecting premium. There's still a chance that the stock could go down, and I was ready to sell it anyway. Now, that's the beauty of options, is that you literally have options of things to do. Raise your strike, keep the same strike. You can go down in strike, maybe if you change your thesis or you want more protection, right? You could lower your strike and then have a bigger cushion if there's a big downfall, kind of use it as a hedge. So there's a few things you could do, but that's currently what I'm doing with that ELF position. Another important position in my portfolio is Celsius Holdings, which when I sold this, so first I have two positions. I have a cash secured put, I have two of them, which I sold a very aggressive cash secured put when the stock was around 30-ish bucks. I sold a $35 put. It paid about $500, something like that. And I did two of them. Now, the stock dropped all the way to 24 something. Okay. 23.81. I actually bought about 50 more shares at that price. Should have bought more in hindsight. Now, I could have easily said, you know what? I'm going to get assigned. I give up, right? Or whatever, right? Which I could have taken assignment at 35 bucks. I got paid 500, so my cost basis there would be 30, and just hold the shares till there's a more opportune time to sell covered calls. Or, right, what I did was I bought more shares to lower my cost basis. And actually what I did was I didn't want to necessarily take assignment in that moment if I had the opportunity to roll it. So what I did was this kind of the same thing I did with my ELF position, was that I rolled I did the same strike $35 put, and because it had so much intrinsic value, that basically it paid. It paid at the time. I'm not sure where it shows what it paid exactly for that roll, but basically I got a credit. I think it was about 1% or so, but I rolled it 1 month, got paid, kept the same strike, and now the stock price literally is 34.70, which means I extended my time, I got paid, kept the same strike, just held my ground, just like William Wallace in Braveheart. Hold, right? Just held, right? Just held. Hold. Wow, what a great movie. Anyway. Okay, so 34.71. So now what's going to happen is with Celsius, I have till September 18th. My average cost is 33.34. So as the stock was dropping, I tried to keep accumulating shares, right? I have two cash secured puts, right? Which if that expires above 35, I'll probably just take my collateral back or sell more $35 puts or something like that. But we'll see. You know, the market's always changing, ebbing and flowing, so you have to take the opportunities when you see them. And sometimes your decision will change based on what's happening. So I have that going. And also I have $35 cover calls. Now, when the stock was so deep in the money, or just, right, the stock price was like 30 or 27, 25, right? This looks so far away, and I have 6 contracts, 6 covered calls. Now, because my cost basis is lower, and I've been lowering my cost basis all the way from cost basis of 38 to about 33 now, 33 something. Now, if I sell the shares at 35, I'm actually in a profit no matter what. After all what happened, after all the drama, I'm still in the profit, right? So now, ideally, I'm basically hoping the stock just kind of bobbles around. Maybe it goes above 35, maybe it stays below. But if it's around this range, that gives me so much to work with. If I extend the time, I could extend the strike, I could do a lot of things. Yeah, so that's pretty good. And literally on one of my last on my Celsius video I made, basically some guy commented like, bad timing, right? And the second I sold or I closed my covered call, the stock dropped. um which, it happens. And then, in the end we still end up in profit and good things happen. And that's why you just really got to know what you're doing. And yeah, and you just know the risk you're taking, and you just go with it. So the stock is, 34.73. And yeah, I'm pretty happy overall. Celsius is a stock that for the long term, I think it does have a really high potential. I think there's good fundamentals, and there's a lot of little like drama things that are happening that, I think it's just making the stock story a little bit messy. But so my personal opinion, I don't think it's gonna just shoot up, parabolically, but I think it is gonna steadily rise if we're in a good market condition. But we'll see what happens, right? I don't have a crystal ball, but yeah, that's a big position for me. Another important reason for me that I have Celsius, I have ELF, um, is that those positions are detached from AI, right? So you kind of have this uncorrelated asset that, I mean, if you have everything in I mean, so many names have dropped in AI. I mean, AMD is a big holding of me. That's my AI play. But it's just had a bit of weakness lately. Down 11%. It's not too bad compared to a lot of other names. I don't know. What's another AI? Let's just say, I don't know, CoreWeave. Let's see, CoreWeave. Like if you're in AI, let's see here. Okay, not bad. Okay, 1 week, it's down, I don't know, 18%. 1 month, 3 month, down 19%. Right? Let's say, what's another AI? Let's say Nebius. I don't even know what they do exactly, but I know they're AI. Nebius, down 3 months. Okay, 1 year, that's actually really good. 1 month, very good. 1 week, 24%. Oh my goodness. Okay, so let's say that, right? When AI goes down and there's correlated names, if you're just in AI, everything's going to go down. But when you have uncorrelated names, that's really the key to kind of having a bit of diversification, is that, AI is not going to disrupt energy drinks, and it's definitely not as going to disrupt makeup, right? People are going to wear makeup, people are going to drink drinks, right? So that's kind of nice to have something that is uncorrelated. That's definitely alpha right there. SoFi, still a big position for me, not doing a single thing with my shares right now. That one, definitely I sleep pretty well at night knowing I have SoFi, but my position's pretty much built out. I don't really want any more uh, at this moment. Yeah, let's take a look at the charts now for Celsius and ELF, just to show you kind of also just some other little data points. Is that, let's see here. So this is Celsius Holdings. Now this is the Bollinger Band, which shows us the probability within about 2 standard deviations that the stock should stay within. We're at the top of the Bollinger Band. We actually breached the Bollinger Band. Let's take a look here. Yeah, for 6 month, 3 month, 1 month. Yeah, we're at the top, and we have an RSI of 67. Now, anytime you get about 70-ish, you're getting to that overbought territory. So the stock most likely will probably, bounce off that, go down a little bit, kind of revert, but nothing's guaranteed. It could also just keep going, but most likely it'll probably go back down somewhere here, right? So that's just one indicator. We also have ELF, which is in a similar situation where the RSI is 73 and it's at the top of the Bollinger Band. So, it's most likely gonna kind of bounce off there, consolidate there, probably not go too much higher in the very short term. but it does have a lot of momentum now. So nothing is guaranteed. It could definitely keep going up. But the RSI really does indicate that it's overbought. So that now would be an ideal time to start selling those covered calls. But yeah, that's pretty much my main positions that are not correlated really with AI. And yeah, I got my AMD position, SoFi position. I do have a bit of margin, not too much, maybe about 20-ish% or so. So that's also why right now, but I want to de-risk a little bit. So I'm basically more willing to sell those ELF shares, just so I can kind of stack up some cash and be on the little bit of maybe the defensive, a little bit. Just want to have a little bit of dry powder ready just in case anything happens. Portfolio is basically at all-time highs. And another play, I just want to throw in this little bit here is Netflix, for another potential play that I want to do. Maybe cash secured puts, something that just really has a solid business model. Again, detached from AI. People want to watch movies. You have a Netflix account, and even if you don't watch Netflix, you just have it. It's just one of your bills now. It's like the internet, or it's like your water bill, your Netflix bill, right? You just have it, right? So it's very stable, good business model, very clean story, um, very profitable, and the PE is very reasonable. So that's just another play I'm looking at, maybe as soon as I have some cash. Um, yeah, because my ELF position, I have a $90 call. I also have a 105 covered call as well. So these are, it's a lot of money tied up in this position. How much is that exactly? Let's just see. So yeah, right now the market value of ELF is about 38. That's a lot of money in one position. About 18% of my portfolio. So I'm a bit concentrated in that one. Um, and I'm a bit concentrated in Celsius as well. So I am aware that I am in a position where I'm a bit overexposed, I think. So I do want to just, yeah, Celsius about 10%, 11%, and about 23 grand there. So yeah, I'm just in a position where I am a bit overexposed for my liking at this moment, especially having a little bit of margin. So I would like to de-risk. So sometimes you could break the rules of, diversification, stuff like that, but just know the risk you're taking, and just know that I'm on the path to de-risk a bit, knowing that I am a bit overexposed. Because when the market's good, everyone's making money, but when the market takes a nosedive, that's what separates the boys from the men. So anyway, that's pretty much it. Let me know if you got any value looking through my portfolio and hearing me talk through some of my positions. Hit the like and subscribe button if you wouldn't mind. That would really help out the channel. And I will see you in the next video.